When people hear the word ETF, it might sound like something technical or complex, but the idea behind the ETFs is actually one of the simplest and smartest concepts in the entire world of investing. An ETF lets you buy a whole group of assets all at once instead of buying them one by one. That's it. ETF stands for Exchange Traded Fund, and the easiest way to understand it is with a real-life analogy. Imagine going to a grocery store and instead of buying every ingredient separately, rice, chicken, vegetables, you pick a pre-made meal box that already includes everything you need. One purchase gives you access to all of it. That meal box is your ETF. In the financial world, an ETF is a basket that can contain stocks, bonds, commodities, currencies, or even other ETFs. Instead of buying one company, you buy a collection of companies. Instead of buying one bond, you buy a mix of bonds. Instead of choosing between gold, silver, and oil, you can buy an ETF that contains all of them. One of the most popular ETFs in the world is the SPY, which tracks the SP 500, the 500 largest companies in the United States. When you buy one share of SPY, you're essentially buying tiny pieces of all 500 companies. Apple, Microsoft, Amazon, Google, all of them are inside that single ETF. This makes ETF powerful for diversification. If one company performs poorly, the others in the ETF help balance it out. It's like being part of a team. If one player has a bad day, the team can still win. That's the advantage of owning a group instead of relying on a single stock. Another great benefit of ETFs is that they are traded like stocks. You can buy and sell them instantly in one exchange, anytime the market's open. They move up or down in price just like individual stocks, which gives you flexibility. ETFs are also known for being low cost. Traditional mutual funds often have high management fees because a team of analysts constantly adjusts them. ETFs, on the other hand, are often automated. They track indices, so fees are low, sometimes incredibly low, and fee matters. Lower fees mean more money stays in your pocket over time. There are many different types of ETFs, and each serves a unique purpose. Here are a few. Index ETFs track major indices like the SP 500, Nasdaq, and the Dow Jones. Sector ETFs focus on industries like technology, healthcare, energy, or finance. Bond ETFs, mix of government or corporate bonds. Commodity ETFs like gold, silver, oil, or agriculture. International ETFs invest in markets outside your home country. Dividend ETFs combine companies that pay consistent dividends. Thematic ETFs focus on trends like AI, clean energy, or cybersecurity. Think of the ETFs as different playlists. An index ETF is like a top hits playlist. A tech ETF is like the best tech playlist. A clean energy ETF is like a playlist called Future Energy. You pick the playlist based on the theme or mood you're going for. One of the biggest reasons ETFs have become so popular is because they make long-term investing simple. Instead of trying to pick next big stock, you invest in the broad ETF and let the entire market work for you. Historically, markets grow over time. Even though recession, crashes, and volatility, ETFs gives you exposure to that long-term growth without needing to constantly research individual companies. ETFs also help reduce risk. If you buy a single company and it goes bankrupt, you could lose everything. But if you buy an ETF with 50, 100, or 500 companies, one failure barely makes a dent. It's like carrying your groceries in multiple bags instead of putting everything in one. In the world of trading, ETFs also give access to markets that are otherwise difficult to reach. For example, buying physical gold is complicated. Trading gold directly is even more complicated. But buying a gold ETF or an oil ETF is simple. You click once you're in. ETFs blend both worlds. They are simple enough for beginners, but flexible enough for advanced traders who use them for hedging, diversification, or even leverage. And yes, there are also leveraged ETFs, which multiply the movement of the index they follow. For example, a 2x leverage ETF aims to double the daily movement of the underlying asset. They are powerful tools for short-term trading, but risky for beginners because they move fast and reset daily. Now, here's where ETFs become even more interesting. They can be used alongside the smart money concepts. Many traders analyze structure, liquidity, and displacement on ETFs, just like they do on stocks or forex. Because ETFs reflect real market order flow, they show clean price action. You can apply the smart money concept ideas like liquidity grabs, mitigation, fair value gaps, and structure breaks to ETFs without any problem. Let's bring this all together with a simple story. Imagine you want to invest in technology sector, but you're not sure whether you choose Apple, Microsoft, or Google. Instead of choosing one, you buy a technology ETF. Now you own pieces of all of them. If one struggles, the other helps balance it. It's simple, efficient, and diversified. So to summarize, the ETFs are baskets of assets you can trade like stocks. They offer instant diversification, low cost, and access to almost any market. They are great for long-term investing and also useful for traders. And they give beginners a safer way to enter the world of investing without betting on a single company. ETFs aren't complicated, they're practical, they're efficient, and they make investing easier for everyone. From beginners building their first portfolio to advanced traders managing complex strategies.